Gautam Dugar is with us, Head of Research Institutional Equities at Motilal Oswal Financial Services. Gautam, great to have you with us here. Thanks for your time. I'm going to get to your earnings estimates and how it's moved because Q2 was bad. A lot depends on the H2. But I want to start with the investment from Motilal Oswal into Zepto. So Zepto has raised $300 million, $5 billion valuation. Ramdevji himself is putting money in. He's already an investor. But I think the company is also putting money in. I know you have coverage on Swiggy and Zomato as well. So just talk us through how this fundraise changes the game and what are your projections here? Are these still good plays for retail investors? Go on.
Good morning, Prashant. Thanks for having me here. The investment that you're referring to in Zepto has been done by our asset management firm, so I won't be able to comment on that. But as regards the broader point on quick commerce, we are very hot on that space. Been holding Zomato since 50 rupees in our model portfolio, and we still like this space. We've recently put out a coverage on Swiggy, which is very detailed, granular analysis of all the three different businesses of Swiggy. The fact remains that this is a very rare segment within the overall consumption space because, as we all know now, overall broader consumption space has slowed down. But within that, there are pockets of sub-consumption segment, as one may refer to, which are growing at a very breakneck speed. And the kind of scale that some of these companies have achieved in the last 2.5 years, or maybe 3 years post-COVID, is phenomenal. So, and we have seen it in the case of Zomato over the last 3 years. When they listed, they were loss-making, and within no time, now we are projecting a profit of almost 3,000 crores. So it's a big company with big market cap and very high growth. The fact remains that the segment is still evolving. So while we've already seen 3-4 years of good growth in the spaces, if you look at the next 5 or 10 years, I think it's quite probable that at an industry level itself, we might clock a growth rate CAGR of 20% over 10 years. Of course, today 20% for this segment may look less because they are growing at 40-50%. But if you stretch that out over a 10-year period, at a top line basis for the industry as a whole put together, 20% is a very good number. And as of now, there are only 2 or 3 players with size. So definitely there are going to be a lot of winners in the spaces. Difficult to say who will be the biggest winner. So it makes sense, in our view at least, to put a bet on 2-3 names. As far as our own model portfolio is concerned, we've been holding Zomato and continue to stay positive on it.
Hi, Gautam. Good morning and good to see you. Before we get to the earnings and the way the government is spending, that's going to help us in the second half of the year. Any of these Adani Group stocks have come to levels that you like it? You'll have an official call, I think, on ACC and Ambuja as well. They have corrected 30% from the peak. Your view?
Hi, Nigel. I was referring to your comment on Kohli. Kohli is out, by the way.
I know. Kohli is out. Yeah, that was unfortunate. 40 for 3. Hopefully, we can put in a bit of a fight. I had a dream of going and watching the game Boxing Day, but I've postponed it for the next year, I think. So, or the next time we go down there. Difficult times, and I'm sure our boys will bounce back.
Hope so. Referring to your question on cement, no, we don't like cement as a space. We don't have any exposure to cement stocks in the model portfolio. The numbers are very bad, actually. And I think the numbers are going to look weak over the next 2 quarters, too. This was incidentally the 5th consecutive quarter of a double-digit profit decline in cement. If I look at my coverage universe itself, I think we have seen somewhere close to 45% profit decline for our coverage universe put together. As we move forward, March typically is the best quarter for the cement sector. We will see how things pan out by then. Definitely not at the moment. We don't have any exposure to cement stock. We are actually playing industrials theme through capital goods. We are playing industrials theme through real estate and all, where some prices have corrected. And in fact, while the overall earnings season was very muted with a very flattish performance at an aggregate level, but if you look at the sectors, then capital goods stands out because they were able to beat expectations. We have seen close to 17% earnings growth in capital goods versus our expectation of somewhere close to 10-11%. And even at a top line level, they've beaten expectations with a very strong 20% top line and EBITDA growth. So very few sectors have managed to beat the top line expectations. Capital goods is one of them. right? So we are positive on L&T, we're positive on Cummins, Capital Goods, basically ABB also. Now that stock is down 20-25% from the recent highs because there was a blip in the quarter. So Capital Goods is the way we are playing the industrials theme rather than cement.
Got it.
Capital Goods, okay. And that ties in with the theme as well. Hi, Gautam. Morning. Great to have you on. Ties in with the expectations, right? Everyone's expecting government spending to start picking up, and in general, the sense to start, improving for the capex part of the economy. So that ties right in. But what else? If I were to ask you about areas of the market which will give the best second half earnings growth, apart from capital goods, what would it be?
So Surbhi, yes, you're right. Capital goods should do well. Apart from that, the spaces that we have liked, and in fact, we've recently, in fact, 6 months back, we moved IT from underweight to overweight. And we've doubled our weight in IT between the last 6 months, from 8% to 15%. And if you look at the performance, IT sector stood out in the last 3-4 months in the current phase of market downturn. Earnings has also been decent. We're expecting pick up there. Our preference within IT lies in mid-cap, not really mid-cap nowadays, because both Persistent and Coforge have reasonably big market caps. Within the mega cap in IT, we like HCL Tech. So as regards your specific questions on sectors which are expected to do well, we do expect the second half to be slightly better than first half, because the first half, our coverage universe has 0 growth and Nifty at 4%. Now, in the second half, we're expecting our coverage to move from 0% to 9%, and for Nifty to move from 4% to 7%. So that's how we get a full year 5% earnings growth for Nifty. But, there are a lot of, nuances in this. If you look at the numbers excluding commodities, which I usually do, the next commodities, Nifty, the first half growth was 12%, and second half growth is also about 10 to 12%. And similarly for our broader coverage, first half was 13%, second half is 13%. So whatever variations you are seeing between the two halves of the FY25 earnings is largely or completely coming because of commodity-related fluctuations. As regards sectors where we are still expecting good growth and are positive on it, so I mentioned IT, second is BFSI, and within BFSI, we like the non-lending financial space more. And we've also moved private banks recently in October preview to overweight out from underweight after a long 2.5 years, period. And also we like healthcare, select bits of consumer discretionary, telecom. So those are 5-6 spaces, and of course real estate where we are overweight. We are expecting the growth to continue to remain strong. Right?
Okay,
but
that's
the year is going to be quite soft on aggregate earnings basis.
And I guess a lot of that is in the price, right? That explains the fact that we're down 10% from the peak. Somewhere when the reality catches up, the question is, what do you start playing from here on? And you've given plenty of ideas. Very quickly, Gautam, before we let you go, we were just looking at some notes that came in from a bunch of foreign brokers this morning on Reliance. They were talking about how, in general, refining, the cycle will start picking up, and it should be good for Reliance, and I'm sure other refiners as well, global refiners. Just want to get your view here, because like you pointed out, commodities have been the culprit in pulling down Q2 numbers, some of the commodity-facing sectors. What would your sense be? Because if Reliance starts moving higher, we know it takes the market along with it.
Yeah, I absolutely agree with you on the first point. So we've had a 8% earnings downgrade since April, and the Nifty is also down about 10-11%. In fact, if you look at the broader markets, the 3-year CAGR is very, very ordinary now. We've seen just 10% earnings, basically the Nifty return CAGR. On Reliance, we are still underweight, so because we think that not just the refining and the O2C business, but even the retail business has slowed down a bit because of the overall demand slowdown that we are witnessing in the the modern trade part of the consumption basket. So I think while valuations have corrected, stock has corrected, in the near term we don't see much of a trigger out there. So and because it's such a big weight, it's very difficult to go overweight there as it is, even when the earnings are doing well. But at the moment, we are underweight, and we are using that weight to, basically allocate more towards sectors where the earnings visibility is far better right now.
Okay. Your 25 Nifty EPS and 26 EPS estimate now, Gautam?
Yeah, Prashant, so we are at 1,057 for FY25 now, which is a downgrade of about 1.5% from the preview to review. And for FY26, we are close to 1,240. Which is an earnings growth of close to 17%. So now, if you look at FY22 to FY25, our earnings CAGR would be somewhere close to 12-13%. Sorry, on a 3-year basis, it is still 20%. The FY25 year is going to look very, very soft at about 5%. But then FY26 obviously evens out that base. So net on a 5-year CAGR, Prashant, we've seen close to 20% earnings growth now for Nifty. And this is the first year of single-digit earnings growth after 4 consecutive years of very strong double-digit performance.
Got it. Thank you very much, Gautam, for joining us. Appreciate your time here on CNBC TV 18. Have a good weekend. We'll catch up again. Nilesh